you guys. Our objective this morning is really twofold. First, of course, to educate and provide some perspective on what's happened in the market and what we see happening moving forward this year. And second, a second objective, as it is with all of our events, is to create an event that we can spend some time with our clients outside the normal and traditional office setting, as well as to give our clients an opportunity to introduce a friend or bring a guest and have that person have a chance to meet us and hear from us and get an idea of what we're all about. So those of you that brought a friend this morning, we appreciate that, and thank you for doing that. With that, let's get started. Quick word from our attorneys. We appreciate that. Our agenda this morning. I'm going to review 2011 and highlight a couple of things, and then I'm going to hand it over to Ted Earhart to discuss the current economic data, as well as jobs, Europe, housing, as well as some investment opportunities for the year. One of the big items of last year, as you recall, seems like a long time ago, but just 6 months ago, was the topic on the federal debt ceiling. Remember that? How our government was going to increase our debt, avoid default, avoid a government shutdown. And that was one of the big topics of last year. And I think we've also found that a similar discussion takes place across America, in many homes across America, on a family level. How to manage personal finances, manage personal debt, and take care of one's own household debt ceiling, if you will. And I found a great video that I think is very informational and talks about that process. So I want to show that.
What can I do for you today?
I would like to raise my debt limit.
Excuse me?
My debt limit, I'd like to raise it.
Because the last time I checked, Mr. Smith, you were in serious debt.
Yeah, it's pretty bad. Figure we should raise that limit.
Yeah, it says here you're $140,270 in debt.
Right, so I figured we should raise that limit to about $170,000. I just bought a 60-inch flat screen. Have you ever been to Australia?
No.
Leaving tomorrow, mate. You should check it out. Great parasailing.
Do you have some new income that I don't know about?
No, still making about 21 grand a year.
Okay, and are you still spending $38,000 a year?
That's what it says.
So you're adding $17,000 a year in debt.
Oh, is that what it comes out to? Debt limit going up. Ding.
Have you made any cuts in your expenses?
Oh, of course, yes. My wife and I cut $380 out of our annual budget. It's $380.
Brutal. Huh. Okay, so you're adding, okay, so you're adding $17,000 a year to your $140,000 in debt, and you cut $380.
When you say it like that, it makes it not sound like a lot.
Hey, maybe you should think about generating some new income. Maybe a new job, maybe ask for that raise.
Oh, asking for that raise, I'm not comfortable. That's an awkward conversation. I've always been able to raise my debt limit.
Yeah, well, this is a little different.
Well, how?
We're in the middle of a recession, and your credit rating will plummet if you continue to go along this path.
I almost had it.
You don't see how bad this is, do you?
I cut my budget by $380. Are you kidding?
I'm sorry, Mr. Smith. We can't help you.
Just a little.
I'm very sorry.
My wife is going to lose it.
Been there.
I mean, $380 was bad enough. I mean, this is going to end our marriage. We stopped talking to each other for a month. The baby was totally freaked out.
Wait, you have kids?
Yeah. Yeah.
Sign there.
All right. My kid's a blessing. I mean, she's got plenty of time to deal with all this, right?
Absolutely.
Are we all set?
You're all set.
All right. Let's go, kiddo. We got to meet Mommy at the car store. Here we go. I think this is yours.
Thank you. Enjoy.
Thanks. Hey.
Nice to start out with a little humor early in the morning. But I thought that conversation aligns pretty perfectly with our federal government, don't you think? How to sum up 2011? If we were to do that in one phrase, it might look something like this. It was a wild ride and all for nothing, at least as it relates to the stock market and the S&P 500. This is a mountain chart of last year, S&P 500 performance. A lot going on in between, a lot of volatility, which we've been getting more and more accustomed to. But at the end of the day, at the end of the year, almost exactly, a 0% return. The market was actually up 0.04 points. I mean, it literally finished where it started, which has not happened since 1947. So a 0% return in the S&P 500. Market was chugging along nicely till July, until about an 18% sell-off that happened through the summer, perhaps as a result of the debt ceiling conversation, Europe and Greece and a host of other things that caused this. Fortunately, the market clawed its way back in the fourth quarter, right back to 0%, as I said. And today being the last day of January, if the market holds and nothing major goes down today, January will also be a positive month, which will mark 4 straight positive months in the market, which is a good trend. If you stretch this mountain chart back to October of 2007, back here when the S&P was at 1565, of course we remember this. We've talked about this over the last couple of years. Let's not forget, though, that since the market lows of March of 2009, stocks are still up over 90%. Of course, I said the same thing at this time last year, since the market was flat, but we still are up 90% since the lows of 2009. If we look at returns in 2011, as I said, the S&P exactly flat. The Dow, somewhat better, somewhat surprisingly, actually, up 5.5%, keeping in mind that the Dow only tracks 30 stocks, so not as representative as the S&P 500 is, but up 5.5. Foreign stocks, not nearly as well, down 16%. Actually, the U.S. was one of the better markets, or at least one of the better developing markets to be invested in last year. Gold and oil bounced around a lot, but finished up 9 and up 8% for gold and oil. Smart money had a tough year. What do we mean by smart money? Smart money being money that is managed by some of the smartest people in the business, such as John Paulson. Remember this guy? Famous back in 2007. He's a hedge fund manager in New York. One of the few that predicted the subprime mortgage meltdown, actually bet against it, shorted stocks, made a nice little profit in 07 and 2010. Not so much last year. Made some wrong moves in the financials, bank stocks. His fund that he manages down 51%. Meredith Whitney, financial analyst out in New York as well, just over a year ago, went on television, 60 Minutes actually, and had a discussion around our municipal bond market and predicted that hundreds of billions of dollars would be lost in defaults in 2011. Really was a shock to the muni bond market, and didn't materialize at all. A little bit of default, $1.6 billion, but nowhere near the hundreds of billions of dollars that she had predicted. Definitely missed the mark there. Thirdly, Bill Gross. Mr. Gross is probably one of the smartest guys in the fixed income space. He manages the PIMCO Total Return Bond Fund. Missed the mark with treasuries. Actually bet against the U.S. treasuries, thinking that rates would go higher. Rates actually went lower and bond prices went higher. He missed that. Relatively speaking, had a pretty poor performance in 2011 and actually issued a formal apology to his clients saying, I'm just having a bad year. So Even the smartest minds and the brightest minds have difficult years, and that was the case for many this past year. Best and worst major stock markets in 2011. I'm not sure how major they are, but Venezuela, up almost 80% last year. Who invests in Venezuela? Not a one. Okay, that's what I thought. Greece, down 62%, not surprising with all the attention that they've been getting. Greece also held that spot last year, down about 30%. So a couple of bad years in the stock market in Greece. Comparing again to the US being flat, and China, just for information, down 21%. Last year also down 16%. So a lot of talk about China, certainly high growth, high GDP in China, but having a tough time putting that together on their stock market. Quiz time. I believe we have a couple of giveaways here for quiz time. So the first person to answer this question correctly, what was the top performing stock in the Dow in 2011? I'll even give you a little bit of help by giving you that list. What was the top performing stock last year? Call it out. Ford, good guess. No. Caterpillar was last year, Mike. Walmart, no. Nope. We're going to keep going until we get it. McDonald's, the Golden Arches. Kurt is the winner of the very hard to find Trott Brook private labeled wine. There you go. Thanks, Kurt. And on the flip side, I'm sorry, here's our answer. McDonald's, up 30%. Certainly a nice stock to own last year. They were up the year prior as well. So Golden Arches, they're doing something right. What was the worst performing stock in the Dow? And I kind of tipped you off to this answer earlier. There's your list again. Worst performing stock last year. Who said that? There you go, Mr. Huberty. Bank of America. Yep, first guess even. Down 50% with the Bank of America. Incidentally, what is the best performing stock in the Dow this year? Bank of America. Bank of America is up 30% in the first month of this year. Warren Buffett made a $5 billion investment in Bank of America in August. Perhaps a little bit early, but I think looking at his investment today, probably quite happy. No shock. Maybe Warren Buffett is on to something there. Ted Earhart. I'd like to have Ted come forward. Ted has been with Trott Brook Financial for 2 years, and he directs all of our research, our portfolios, our investment recommendations, and I'm going to have him take us the rest of the way. Ted?
Very good. Thanks, Jim. And my hands are going to be kind of busy, evidently. I'm excited to be here, excited to see everybody out. I've spent a lot of time on this presentation, so I'm excited to share with you today. I'm going to hop right in because we got a lot to cover and not a whole lot of time. So let's start out with the economy, and I have good news. The economy continues to improve by most measurements, and today we're going to focus specifically on the trends of the trends that make up GDP, or the two groups specifically, and we're talking about businesses and consumers. Since 2008, prior to the recession, both of these groups have gained in their, I'm getting a little bit tongue-tied here, so bear with me. Their financial health has increased remarkably. Now, before I go down that direction, let's start out with a broad measure of the economy, which of course is GDP. GDP, a technical term, but it's the broadest measure of economic activity here in the U.S. And I'll point up here, you can see the sell-off, or the contraction back in 2008, 2009. And since then, we've had several consistent years of economic activity, economic growth, which is contraction is defined as a recession, and growth is defined as a good economy. So the issue is, of course, growth has not been nearly what we would like it to have been, and but to end the year on a good note, fourth quarter numbers just came out. They're not reflected up here, but fourth quarter numbers for GDP increased again, and we're actually at 2.8% annualized growth. So that's a good trend going into 2012. We've had 3 consecutive quarters of increasing growth. So that's a good trend. Now let me switch gears and focus on those 2 groups that I just mentioned, the 2 groups that actually make up economic activity, and we'll start with businesses. I'll direct your attention to the top left here, the graph on the left-hand side, and what that's showing us is cash on the balance sheets of the S&P 500, and it's actually a technical measure. It measures the percentage of cash as percentage as of current assets. Now that's a little bit technical. For practical purposes, what I want you to focus in on is businesses have more cash on their balance sheets than at any time over the last 10 years. That bodes very well going into 2012 for a couple reasons. First of all, businesses can spend money to hire people. At least that's what we're hoping they're doing, but also to upgrade their plant equipment. In addition, it also puts them in a much stronger position to withstand perhaps a jolt in the form of a downturn in economic activity, or if things get a little bit rockier in Europe, businesses are in a much better position to withstand some of those blows. Moving over to income or profitability, over here what we can see is a measure of after-tax profits as a percentage of GDP. What we're seeing is, this is actually pretty phenomenal, and why I chose to show you today. We are at literally a 50-year high in terms of profitability of businesses in this country. And it's pretty startling considering unemployment remains unacceptably high. But that goes with a trend that we're seeing businesses doing a lot more with less, and was one of the reasons why unemployment stays high. And we're going to get to that in a couple minutes here. So I always like to interject a little bit of local data. Here are a list of Minnesota companies that fit right into this narrative that we're discussing, businesses improving their financial standing. So you can take what we're looking at, I should tell you that first, is the change in cash that these businesses held on their balance sheet between 2008 and now. This is about 6 months into 2011. So take a look at Alliant Tech, which of course owns Federal Cartridge right in Anoka. They've increased their cash position by about 2,000%. Pretty substantial, I think we could all agree. Polaris, of course, Select Comfort, and right on down the list. So again, this trend of businesses being much leaner and much more financially healthy persists here right in the state. So switching to the other component of economic activity, the consumer, what we can see is the thing that is typically most important for folks is wages. If wages are going up, people can spend more money, and what we've seen is just that. You saw this terrible contraction of wages as businesses literally cut salaries and cut employment through the recession, but now look at wages have finally stabilized to the point where, and we're actually seeing some growth on a year-by-year basis, month after month, and that, fortunately, is translated into new orders of durable goods. So to put this in more simplistic terms, it means people are spending money, and they're not spending money just on things like gas and groceries. They're actually spending money on things with some lasting value. So think of things such as home improvements, appliances, the things that have some lasting value. This does not include cars, but the big focus, what I want you to take a look at, is we've seen month after month after month a steady positive trend here for the consumer, and that bodes very well going into 2012, or this year. Now, I have a somewhat untraditional measure here. There's always weak spots in the economy, and I think most would agree. We hear a lot about this. Construction continues to be very weak, especially related to housing. And here's a measure. I actually got the idea for this by someone who's here today. Roger Renner is joining us, and he owns a company, E.H. Renner and Sons. They drill wells for water for folks. And we were speaking within the last year, and he was kind of sharing some data with me in terms of, you know, how many wells are we drilling today versus a couple of years ago during the housing crisis. And I thought, you know, what a great way to measure where the economic activity is, especially as it relates to housing. but we're talking commercial and residential here. So let's take a look at the data where we actually stand. Now this information comes from the Minnesota Department of Health, and look how sizably the change has been. Going back to 2006, which is when housing peaked, we were at upwards of 12,000 new wells being drilled right here in the state of Minnesota. Today we're at roughly a third of that. So construction and housing in general continues to be one of the weakest spots in the economy. So pretty interesting, I thought. One other non-traditional measure is that of illegal immigration. It seems the tough economy has actually had an impact on illegal immigration. And take a look, I'll point you to the top when illegal immigration peaked in 2000. Where was the economy in 2000? It was hot, right? It was about the hottest it's ever been. And then we saw a recession after it started a little bit before 9/11, but 9/11 happened and things spiraled deeper. We see the rebound with the housing bubble, and look at what has happened to illegal immigration since. And this is measuring apprehensions along the Mexican border. So very interesting how the economy can have wide-ranging influences on things that you perhaps wouldn't always think it does influence. So pretty good. Let me move on here to an investment opportunity that we see and we have been implementing into our portfolios for clients, and that has to do with businesses being strong. Businesses are operating much more efficiently. They have a lot of cash on the balance sheets, and most importantly, profitability is up. That is translating into more dividends. Businesses, instead of investing in plant and equipment very heavily, have decided to pay shareholders more. So I'm going to show you a couple examples here of what I'm talking about, and to be sure, these are not recommendations for individual buys, but just some good examples of what's going on today in terms of dividend yields. So take a look at this, pretty astounding. You can buy AT&T common stock today, and even if the price stays flat, you're going to get a 6% dividend yield. And what I like about this list, which is interesting to me, is we're not talking about one particular industry doing well. We're talking about a huge swath of American industries. We have telecom represented, Reynolds America, the tobacco company, Lockheed Martin, defense. Of course, there's energy up there, pharmaceutical, and even look at McDonald's, the best performing stock in the Dow last year, yields almost 3% in a cash dividend. So this is an opportunity we like. And if you go back a couple months when the stock prices were depressed, these yields were even about, they were about 10, 20% higher. So as stock prices go up, these yields go down, but today this opportunity remains. So let's switch gears a little bit to jobs and employment, and let me grab a swig of water here before we go that direction. Okay, so jobs and employment. My hope here is to show a couple trends that I hope you can share with people that you know in your life who are entering the workforce or considering a career change, because we've seen a dramatic change in the way businesses are hiring. And I'm specifically going to speak to labor being replaced with capital equipment. And the businesses that are hiring are seeking folks with specific skills. So let's take a look. We'll first start out by taking a look at where unemployment remains. And here we go, coming out of the recession, or actually this is the recession going up, and we've seen job numbers, or this is unemployment, we've seen that unemployment number tick down ever so slightly. It certainly isn't fast enough to really be meaningful. And interestingly enough, perhaps you've heard this, no president has ever been reelected when unemployment remains above 8%. So we'll see if that historical trend remains true this upcoming election season. But we still have these high numbers because we lost 9 million jobs throughout the recession. We've only gained about 3 million back. So let me start off by talking about this trend of businesses replacing labor with capital equipment. And one of the things driving this is the low interest rate environment that we're in today, okay? Money is cheap. Everybody who has a mortgage here, especially if you've been able to refinance recently, knows that interest rates are the lowest they've been in at least 50 years. Businesses have taken advantage of that, purchased new plant and equipment, and this has made them more efficient and made those profit margins nice and fat like we've seen, but it hasn't done much for employment. And look at this data that we have here describes that perfectly. What we're looking at up here is capital expenditures by businesses since the recession. Now that has increased by 30%. Well, at the same token on the bottom here, look at private sector jobs. 1.5% increase approximately. So businesses have done what folks would like them to do, spend money, but the paradox is it hasn't led to necessarily more jobs. Here's a couple case studies, a couple examples I wanted to mention that are really telling of this continuing trend. Sunny Delight, the big juice company, they have substantial operations out in Ohio, and they plan on spending $70 million this year to upgrade their plant and equipment. When it's all said and done, they're going to be able to substantially increase the amount of capacity they have in production with a 30% reduced labor force. So very interesting. Steel, the big German company. I bet a lot of you have a piece of steel equipment in your garage. I know I have a couple. They have sizable operations here in the U.S. In fact, their biggest plant, or most technologically advanced plant that is over in Virginia. And Steel is planning on purchasing $10 million of new equipment this year, which is going to double the capacity in production available to this company. And to do that, they're only going to have to hire 6 new people to run this equipment. So pretty incredible. Think about that, doubling the capacity of a big plant with only 6 new hires. And it's a trend we continue to see. So let me turn to the more positive side of things. If people are looking to get into the labor force, where is the place to be? And what we can see up here is what we're looking at is the percentage change in industries. And this is actually, let me further define that, the employment change in industries across the economy. And look at the runaway winner. By and large, mining and logging grew almost 12% in the number of people they employ last year. Incredible. Now, mining and logging, let me further define what that is. Mining includes coal mining, drilling for natural gas, and of course, oil. And we've seen that especially out in North Dakota, if you've been keeping up on the papers and such. But I'll also point your attention to business services and healthcare as well, are also right up there on the top, but we're going to come back to those in a second. But look at the bottom. Look at the places that we're seeing jobs shed. Biggest surprise to me, we're seeing contraction in government. And what was once the poster child for job stability, that's been turned on its head throughout this recession. Very interesting. Now, this is somewhat the same information, but presented in a different way. What we're looking at here is nominal jobs created by these different industries. Now, we saw mining and logging was by far where the growth was, but look at the number of people actually hired. It was only about 100,000 people, which is significant, but it's not a real representation of the overall economy. Where the numbers of jobs are being created, and this is the point I want you to take away and you can share with others, is we're seeing the growth in numbers in business services and in healthcare. And business services, that's a pretty broad category, but it includes professionals. It includes people who are lawyers, accountants, engineers, architects, people with specific skills, and in some cases, not always formal educations, but have been trained to do a specific job. And then, of course, there's healthcare. As most of you know, my wife is in the healthcare industry, and I'm happy about that. But I'm confident, when I speak to folks who are getting ready to enter the job force, the number one industry that comes to my mind to get into is healthcare. This trend is going to continue for decades to come. Why? What is happening in the Western world in terms of demographic change? We're aging, right? We got the baby boomers, the silver tsunami. It's coming, and we're seeing that reflected in the jobs numbers. So, moving on. We've talked a lot about the U.S. here. Let's move on to the global economy, and I'm going to talk about Europe. I talked about this 6 months ago. So if you were here 6 months ago and joined us, some of this is going to be a repeat because the sad thing is not much has changed in Europe. A lot of the same problems exist. But we're going to comment on it nonetheless because it drove the market substantially through the last half of the year. And the one thing that has changed, and I'm excited to share with you, is I found this cool song that really kind of depicts the situation in Europe. So I hope you enjoy this. Sit back and enjoy the show here.
Portugal, Ireland, Greece, and Spain. Who's gonna bail them out?
Greece is solving debt crisis, brought the government to the brink of collapse as public fury over savage austerity measures erupted in pitched battles with police on the streets of Athens.
There's much to blame for this crisis. Deregulation, speculation, the mortgage scams. It started in the late 90s when European nations said, let's get together. Big deal countries, big deal currencies, the Netherlands, France and Germany didn't want everybody in that club. Greece only got it because the bottom was flood. When you use that euros, just one cash. When things get rough, you get the value. Cash evaluation helps when recessions are fun. It's easier for foreigners to buy a good. When markets crash in the Eurozone, speculators said Greece can't pay the loan. Since they use the euro, they can't afford this mess by putting more money to refinance it. Portugal, Ireland, Greece, and Spain. Who's gonna bail them out? Don't take that money, let's just save that money. Who's to say it won't happen again? But they don't understand. You're not allowed to spend more than you can. And now you might default. You're feeling so deflated. It's your crisis that just concentrated.
It has emerged that Greece will not be able to meet the terms of last year's rescue and is hoping to ask the Eurozone for more funds.
In the 90s, low interest and inflation made them look so strong. Underneath the growth and the easy spend, it was the fact that it was backed by foreign funds. Three nations have been given bailout checks. Greece, Ireland, Portugal, Spain, that. Money never comes without strings attached. Austerity measures designed to save cash. Greece spent too much, couldn't raise enough tax. Cut payments to debt without Goldman Sachs. Austerity measures were very stern. Strikes to the rise, cause the nations are run. See, it's not about the bailouts and the debt of the mouse. At the end of the day, it's all about jobs. Unemployment for some is over 20%. What's $1 billion bill when you can't pay your rent? Portugal, Ireland, Greece, and Spain. Who's gonna bail them out? Don't take that money, let's just save that money. Who's to say it won't happen again?
Okay, that's all I'm going to go with that. Doesn't it just kind of make you want to jump out of your chair and dance, though? I love that song for its beat, of course, but more so for its historical accuracy. It's kind of hard to follow the first time you watch it because it's fast-paced, but so make sure if you want to watch it again, if I can move on here. If you do want to watch it again, just email me and I'd be happy to share the link with you because it's really good, again, just because of how accurate everything in that song is exactly what's happened. My hope for you today is, what I hope to do is describe the risk that Europe continues to pose to the global economy and why it seems to persist and we can't seem to come to a resolution and fix the issues. So the big problem and the risk that is posed by Europe is this so-called domino effect or risk of contagion. Now, what does that exactly mean? Well, we saw it here in the U.S. in 2008 with the collapse of Lehman Brothers. Lehman Brothers declared bankruptcy, and that started a domino effect that nearly took down the global financial system. However, the U.S. government stepped in and stopped that from happening. And the same thing could potentially happen here, but instead of it being businesses, we're talking about actual countries defaulting. And let's take a look at how that happens. So here's a roadmap of a country on the verge of default or bankruptcy. And what we're looking at is the yield or the interest rates that Greece has to pay on its foreign, or that Greece has to pay on its debt. So we can see substantial increase here going into the summer of 2011. But before I speak specifically to this graph here, a country going into default requires a couple things. First of all, it requires a company to have more debt than it can really have a chance at servicing or paying back. And secondly, it requires a country that cannot manipulate its own currency. And that is unique to Europe. Europe is tied together by 17 countries by one common currency, the euro. Here in the US, we can actually physically print money. If the United States government gets in trouble, they can create money out of thin air to pay the debt. Now that has a lot of consequences on its own in the forms of inflation and such. However, it can literally make this problem go away. The countries in Europe do not have that luxury, if you want to call it that. So what happens is exactly what would happen to a business. You can see Greece was able to finance their debt pretty cheaply up until about 2010 when the markets realized, geez, there's a good chance that they're not going to be able to pay this debt back. And come 2011, mid-year, it became clear that there was no chance Greece was going to be able to pay its debt. And look what happened to interest rates. They went up to nearly 30%. Now, you can imagine if you yourself are carrying an immense amount of debt, you're able to service it in single-digit interest rates. What happens when interest rates spike to 30%? You almost immediately will go broke. Now, the European Central Bank stepped in and prevented Greece from going into default, which was literally perhaps hours away. And the reason why is because this same scenario we're seeing here started to play out in these other countries that we just heard about in my favorite song. Portugal, Ireland, Italy, and Spain saw their interest rates on their debt going up just as much, not as much as Greece, but to the point where they would have a very tough time being able to repay their debt. So the issue continues to be this domino effect. If Greece is to default, even the mere thought of it defaulting is going to take down all these other countries, and it's almost a virtual guarantee it would take down the entire European continent. So you can imagine the consequences that would have in reverberations through the global economy. And unfortunately, again, this problem continues to persist. And the ultimate solution to the problem is really a political solution. Here's today's Wall Street Journal, and the top headline here is Europe tightens its fiscal ties. So here's why we can't come to a solution on this problem. Then just think about here in the U.S. We have a federal government and we have a central bank. We have our own debt problems here, and let's just think back to the summer. Look how good our one government has done in coming up with a solution to address our long-term budgetary issues. Would most of us agree not a very good job? I think so. Imagine having 17 separate governments that are tied together with different cultures, and some of those have been recklessly irresponsible with their finances, and some have been more responsible. Imagine having those folks get together in a room and try to agree who is going to cut their budget, who is going to raise taxes, and how that's all going to pan out. It's an almost near impossibility, which is why this has persistently been an issue. The ultimate solution is the entire European zone is going to have to come together and share, or at least somehow coordinate how their governments spend money. So that remains to be seen how that's going to play out. The best thing I can say is come back in 6 months and we'll see what has changed since then. That remains the big issue around the globe. Now let's come back to the U.S. here and talk about housing. And this has been something I've read a lot about recently because it has such a huge influence on our economy here in the U.S. And everybody wants to know, when is housing going to come back? So I hope to share some fundamental concerns of, well, my ultimate goal is to help you understand what caused the massive meltdown in housing prices and what's it going to take for things to turn around. So before we do that, let's take a look at where things have come since the peak of the housing bubble. Now there's a lot of stuff going on up here, but take a look at Minneapolis. Here's Minneapolis. If we look at this number right here, this represents the average decline in prices since the housing bubble popped in 2006. And you can see we're down about 35%. You look at other spots of the country, Las Vegas, housing prices down nearly 60%. We move over, Phoenix, 55%, Miami on the top there, down nearly 50% as well. Now, the one positive trend that I'll note, and as you can see on the right-hand side here, look at the tail of each one of these graphs. You can see it somewhat leveling out. So housing seems to have at least found seems to be close to the bottom. So that's a good, that feels good, but when are prices going to come back? And now I'm going to offer a simplified answer that has to do with the supply and demand of housing, which are the fundamental drivers of price. We all learned in Economics 101, supply and demand. Until they find equilibrium, a fair price cannot be reached. Now, a great example of that today is gold. Where is the demand for gold? It's way up here, right? Where's the supply? It's down here. And the result of that, we've seen a huge increase in the price. Housing is the exact opposite. We have a massive amount of excess inventory and a very modest amount of demand. So we're going to focus in on when are those two things going to come back into equilibrium, and until they occur, prices simply cannot rebound. So let's take a look at what happened first of all. Here is new construction. Back in 05, 06, in the US here we were building almost 2 million homes a year. So that was being added to supply. Now, because of population growth in the country, we have approximately 1.3 million new households created every year. So that means new people that are going to buy a house, added to demand. Let's do a little bit of quick math. If we're building 2 million homes a year, and we only have 1.3 million new folks to live in those homes or purchase them, we have an excess inventory that we're creating of 700,000 homes. Pretty substantial. Doesn't take a PhD in statistics to realize that trend cannot continue in excess. And that's exactly what has happened. The trend ended. And to see how imprudent lending practices also affected the housing bubble, or also affected this inventory, I wanted to show you this data on foreclosures and mortgages that are 90 days past due. Prior to the bubble bursting, we were down closer to 1 million. Today, there's about 3.5 million homes across the country that are in some state of foreclosure. Okay, so that's a little bit of the shadow inventory that you hear a little bit about. And let me go back here, not all of these homes will go into ultimate foreclosure, but nonetheless, they remain a big drag on overall supply and therefore prices. But I want to turn your attention back to where we're at today. So on average, since 2009, we've created about 600,000 new homes a year. Now, we're still creating, population is still growing at about 1.3 million, so that means we have a net surplus of demand, which bodes well for pricing. So I want to do a little bit of math, and let's take a look at what this $700,000 surplus we have today, how long is that going to take to eat up this excess housing? Well, the New York Fed recently estimated there's about 3 million more homes than there are people who live in them. Now, assuming construction stays depressed at around 600,000, over time, all we have to do is take the number of homes in inventory and the excess demand that we're creating, and that ends up being about 4 years. So think about that. We have all this excess inventory, and until it gets soaked up, it's going to be very, very difficult for prices to rebound. Now, I want to emphasize this is a very simplified example. We have these issues like the foreclosure issues I just described, and things like interest rates come into play, and of course local economies that are strong can also have impacts on local housing markets. That we're talking about the U.S. here as a whole, and I think it's pretty fair to say that it's going to be at least another 3 to 5 years before housing has a real chance of recovering. So I hope that helps you with some planning. Maybe it's not the answer people wanted to hear, but nonetheless, the supply and demand ultimately drives the pricing in any asset. Now that leads us to our other investment opportunity we wanted to share with you today, and that's real estate. We've been very aggressive in suggesting real estate be a component of folks' investments. And why is that? Because whenever there's a depressed market, there's always opportunity, and we're seeing that in real estate today. Now, we also recognize most people are like, real estate, I don't want to manage properties per se. A lot of people want to do it passively, so we invest through real estate investment trusts. And for those of you who are clients, most of the clients in the room today probably are familiar with a real estate investment trust, but a real estate investment trust is a pool of money that investors add to, and you have a manager that manages the pool of money and strategically buys real estate in this case, as opposed to a mutual fund who buys stocks. So if you don't have real estate and you'd like to get some, this is a great way to do it. But we would strongly caution you in purchasing a real estate investment trust that has properties that were purchased prior to 2008. Why? Where were prices prior to 2008 for housing? Where were they? They were really high. So real estate investment trusts that have been purchasing, and if I could go back and show you the downward trend in housing prices, and that bodes as well for commercial, we're buying properties today at very distressed levels, which hopefully in the long term sets up an opportunity for not only dividends but capital appreciation. So we're going to sum things up here and get everybody moving on with their day. The economy appears to be strengthening. Housing and the construction business continues to be weak, however. Jobs, like I said, I hope you can share that information, those trends I described with younger people that are entering the workforce, the value of getting some technical training and education. Europe is going to remain a problem until they can solve their political differences. And the problems in Europe are as much a political issue as they are an economic issue. And again, housing, of course, we got to wait until this supply and demand factor comes back into equilibrium to really see a sustained recovery. We talked about investment options or investment opportunities that we see today. Dividend-paying stocks are absolutely an opportunity, and they will go away once prices go up. That's one thing. Those dividend yields and stock prices are inversely related. So, if you like dividends, it's actually good to see a sell-off in the market once in a while. It gives you an opportunity to get a higher yield on those dividends. And of course, real estate. Think about buying today because prices continue to be low, and it's going to set you up well for the future. So I'm going to turn things back over to Jim to finish them off. Thanks so much for listening. I hope I didn't go too long here, but we will be around for questions.
Thank you, Ted. Well done. Before we close, I'd like to draw your attention to the middle of the table. You will find your evaluation form. And these are important for us. We value your feedback, and we want to gather that today. I want to take just 60 seconds, give you the opportunity to fill this form out. I'll even have Nikki and Lisa come around and pick those up. And we have one last bottle of Trott Brook wine to give away, so we'll have a quick drawing when we collect these. We've taken off a question and we've added a question since last time. We took off the question of, do you like the location? We've already decided that we love the location and we love Wells Catering, and we thank PSD LLC for this great space. So we're done asking that question, but we're starting to ask a question, which is number 4. What other topics would you like us to discuss? We'll be back on this stage in almost exactly 6 months. We'll do what's called a halftime report, which is just that. We're checking in midway through the year. So if there's a topic that you think should be addressed, that you'd like to see on that agenda, if not before, please indicate that in number 4. Number 5, if you're new here today or a guest and you're not currently receiving our market commentary and would like to, please indicate that in number 5, and we'll make sure to add you to that list. Number 6, again, if you're a guest or a friend of the firm here today and you are open to learning more about what we do, check yes to that box, and we'll follow up with you. And lastly, number 7, if there's someone that you know that you think would either enjoy this event, enjoy getting our market commentary, or could benefit from some of the work that our firm does, you can certainly indicate that in number 7. And Nikki's working that side of the room, and Lisa, if you could catch this side, and we'll pick these up. Who's on Facebook? Raise your hand. 2/3 of the room. Like us on Facebook, if you would. I want to see a bunch of hits on our site today, and we're making an effort to reach out on Facebook and share our comments there as well. Okay. I think we have everybody in, right? One more to go. In the spirit of fairness, I think I'll have our police chief, Jim Way, here draw from the pile. The winner for a bottle of wine. Amy Lazier. All right, thank you, Amy. That'll do it. Thank you, everybody, for getting up early this morning and joining us. Thank you to our clients for your continued trust, support, and business. We really do appreciate that. Good to see a lot of new faces and guests in the room today. We covered a lot of material and did not leave time for questions, so Ted and myself will be around. Of course, we're available by phone, email, or stop upstairs and see us. Hopefully this spurred some thought and some questions, and we'd love to have a further conversation with you. So make it a great day. It's still January, so Happy New Year, and we'll see you next time. Thank you.